So I'm scrolling through Reddit last week and I come across this post in a personal finance forum. This person writes, I've tried budgeting 5 times in the past 2 years. I make spreadsheets, I download apps, I track every single expense for like 3 weeks, and then I just stop. I feel like I need a PhD in accounting just to manage my own money. Is there a way to build wealth without turning my entire life into a math problem? And I'm sitting there reading this, and I realize this is literally 95% of people. They think building wealth requires this insane level of discipline where you track every penny, you never have fun, you eat chicken and rice for every meal, and you basically turn into a financial robot. But here's what's wild. That's not how wealth actually works. The people who are really building significant wealth, they're not obsessing over every transaction. They figured out something that most people completely miss, and it's going to sound almost too simple when I explain it. My name is Tyler, and I spend way too much time thinking about why smart people do dumb things with money. If you're someone who knows they should be building wealth, but feels completely overwhelmed every time you try to get your finances together, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because what I'm about to show you is based on a principle that applies to basically everything in life, but for some reason, nobody talks about it in the context of personal finance. And once you see it, you can't unsee it. It's going to change how you think about money forever. Okay, so there's this concept called the Pareto principle, also known as the 80-20 rule. It was discovered by this Italian economist in 1896 named Vilfredo Pareto, and he noticed that 80% of Italy's land was owned by 20% of the population. Then he started looking at other things and realized this pattern was everywhere. 80% of your results come from 20% of your efforts. 80% of a company's revenue comes from 20% of its customers. 80% of the world's wealth is held by 20% of the population. And here's the thing, this applies to your personal finances in a way that's honestly kind of shocking when you actually see the math. Look, here's what most people don't realize. You don't need to optimize every single aspect of your financial life to build serious wealth. You need to get like 4 or 5 things right. That's it. 4 or 5 high-impact decisions, and the rest is basically noise. But most people do the exact opposite. They spend hours clipping coupons to save $8 on groceries while completely ignoring the fact that they're losing $30,000 to high-interest debt. They obsess over whether to buy the name brand or generic cereal, while their 401k is sitting in a money market fund earning basically nothing. Let me show you what I'm talking about with actual numbers, because this is where it gets really interesting. According to a 2023 study by Vanguard, the average person spends about 8 hours per month managing their finances. 8 hours. That's 2 full workdays. They're tracking expenses, reviewing receipts, comparing prices, moving money between accounts, all of this stuff. Now, let's say you're making $60,000 a year after taxes. That's roughly $45,000 or about $22 per hour. So those 8 hours you're spending on financial management, that's $176 worth of your time every single month. But here's the crazy part. Most of that time is spent on low-impact activities, moving $50 from checking to savings, deciding whether to buy the name brand or generic pasta, reviewing every line item on your budget to figure out where you spent an extra $12 last month. Meanwhile, the high-impact stuff, the things that actually matter, people spend almost no time on those. So what are the things that actually matter? What's the 20% that generates 80% of your wealth-building results? I'm going to give you the list, and you're probably going to be like, Tyler, this seems too simple. And that's exactly the point. Number 1, your savings rate. This is the big one. Your savings rate, the percentage of your income you keep instead of spend, is the single most important factor in building wealth. Not your investment returns, not whether you buy organic groceries, your savings rate. Let me show you the math. Let's say you make $60,000 a year after taxes. If you save 10% of that, you're saving $6,000 per year. If you invest that at a 7% average annual return, you'll have about $607,000 after 30 years. Now let's say you increase your savings rate to 20%, just double it. You're now saving $12,000 per year. After 30 years at that same 7% return, you'll have $1.2 million. You literally doubled your wealth by focusing on one number, one, and you didn't have to become some investing genius. You didn't need to pick stocks or time the market. You just saved more. Number 2, your housing cost. This is the one that people really don't want to hear, but I'm going to say it anyway. Your housing cost is probably the single largest expense in your budget, and it's also the one where people make the most destructive decisions. According to the Census Bureau, the median rent in the US is about $1,750 per month. But here's what happens. People don't think about housing as a percentage of income. They think about it as what can I afford? And what you can afford, according to a landlord or bank, is very different from what you should actually spend. The standard advice is to spend no more than 30% of your gross income on housing. But here's the thing. If you're making $60,000 a year, that's $1,500 a month on housing. If you can find a place for $1,200 instead of $1,500, you just freed up $300 a month. That's $3,600 per year that can now go toward building wealth. Over 30 years invested at 7%, that $300 per month becomes $363,000. You just became a third of a millionaire by choosing a slightly less expensive apartment. Number 3, high interest debt. Look, if you're carrying credit card debt at 22% interest, nothing else you do financially matters. Nothing. You could be the world's best investor and you'd still be losing money because you can't consistently earn 22% in the market, but you're definitely paying 22% on that debt. According to the Federal Reserve, the average American with credit card debt carries a balance of about $6,200. At 22% interest, if you're making minimum payments of like $150 per month, you'll pay over $10,000 in interest alone, and it'll take you over 17 years to pay off. 17 years! But here's what most people don't realize. Eliminating high-interest debt isn't just about the interest you save. It's about the opportunity cost. That $150 per month in minimum payments, if you paid off the debt and invested that $150 instead, it would become $190,000 over 30 years. Number 4, tax-advantaged accounts. This is the one where people leave the most money on the table, and it drives me crazy. If your employer offers a 401k match and you're not taking it, you're literally turning down free money. Let's say your employer matches 50% up to 6% of your salary. If you're making $60,000, that means if you contribute $3,600 per year, your employer adds another $1,800. That's a 50% instant return. You cannot beat that anywhere else. Nowhere. But according to Vanguard's 2024 report, about 20% of people who have access to an employer match aren't contributing enough to get the full match. They're just leaving thousands of dollars on the table every year. Number 5, your investment allocation. This is the one where people think they need to be Warren Buffett, but actually the opposite is true. The research is incredibly clear on this. For most people, a simple 3-fund portfolio is going to outperform 90% of actively managed investments over the long term. But people don't do this. They think they need to pick individual stocks, or they leave their money in cash because the market seems risky, or they pay some financial advisor 1% of their assets every year to basically do what they could do themselves in 20 minutes. According to Dowbar, the average investor underperforms the market by about 3.5% per year because of behavior, trying to time the market, panic selling, chasing hot stocks. That 3.5% difference on a $100,000 portfolio over 30 years is literally the difference between having $761,000 and $324,000. Now, you might be thinking, okay, Tyler, but what about all the other stuff? What about budgeting for groceries and cutting cable and all that stuff? And look, here's the thing. That stuff isn't completely useless, but it's low impact. It's the 80% of activities that generate 20% of results. Let me give you an example. Let's say you spend an hour clipping coupons and shopping sales and you save $15 on your grocery bill. That's $15 per hour of effort. Now let's say you spend that same hour researching whether you're getting the full employer match on your 401k and fixing it if you're not. That 1 hour could be worth thousands of dollars per year forever. Same amount of time, completely different impact. Or here's another one. People will drive across town to save $5 on gas, but they won't spend 10 minutes on the phone negotiating their cable bill down by $30 per month. The gas savings is one time and costs you time and money to get. The cable savings is recurring and took you one phone call.
This is what I mean by high impact versus low impact activities. Now, here's where it gets really interesting from a psychological perspective because there's a reason people focus on the wrong things. Small financial decisions feel good because you can see immediate results. You clip a coupon, you save $2, you get a little dopamine hit. Your brain likes that. It's instant feedback. But the big financial decisions, those are hard. They require delayed gratification. You increase your 401k contribution by 2% and you see nothing. Your paycheck is slightly smaller and you don't see any benefit for literally decades. Your brain hates that. It wants immediate rewards. So people default to optimizing the small stuff because it feels productive even though it's barely moving the needle. There's also this concept called analysis paralysis. The big financial decisions feel overwhelming, so people avoid them entirely. They don't know how to invest, so they don't invest at all.
They don't know which debt to pay first, so they just make minimum payments on everything. Meanwhile, deciding whether to buy the name brand cereal, that's easy. Your brain can handle that. So you spend all your mental energy on low-stakes decisions and avoid the high-stakes ones that actually matter. Look, here's what actually works. You focus intensely on the 20%, the 5 big things I just talked about, and you automate or simplify everything else. Let me walk you through what this actually looks like in practice. Step 1. Calculate your current savings rate. Take your total income for the last month. Now subtract your total savings and investments for that month. The percentage left over is your savings rate. If it's under 15%, that's your first target. You need to get it to 15% minimum. 20% is better. 25% or more, and you're in wealth-building beast mode. Step 2. Audit your housing cost. Pull up your rent or mortgage payment. Divide it by your gross monthly income. If it's over 30%, you have a housing problem. You're either in too expensive a place or you need to increase your income. Those are your only 2 options. Now, you might not be able to move tomorrow, but you need to make this a priority for your next move. Every percentage point you can reduce your housing cost below 30% is money that goes directly toward building wealth. Step 3. Eliminate high-interest debt with extreme prejudice. If you have any debt over 10% interest, that becomes priority number 1. Not priority number 3, not something you'll get to eventually, priority 1. You need to throw every extra dollar at that debt until it's gone. Pick up a side hustle. Sell stuff you don't need. Cut every expense you can. This is a financial emergency, even if it doesn't feel like one. Step 4. Max out the employer match. Log into your 401k account right now. Like literally pause this video and do it. Check if you're getting the full employer match. If you're not, increase your contribution until you are. This is free money. You don't leave free money on the table. Step 5. Set up a dead simple investment strategy. If you're in your 20s or 30s, you literally just need a target date retirement fund. That's it. One fund. Pick the one with a date around when you turn 65, put all your retirement money in it, and forget it exists. If you want to be slightly more sophisticated, do a 3-fund portfolio, a total U.S. stock market index fund, a total international stock market index fund, and a total bond market index fund. Allocate based on your age and risk tolerance, rebalance once a year, done. You do not need to pick individual stocks. You do not need to time the market. You do not need to pay someone 1% of your assets to manage this for you. Now, here's the part that makes this actually sustainable. You automate everything. The reason people fail at personal finance isn't because they don't know what to do, it's because they try to rely on willpower and discipline every single day. And willpower is a finite resource. Eventually, you're going to be tired or stressed or distracted, and you're going to skip investing that month. But if it's automated, it doesn't matter how you feel. The money moves automatically from your paycheck to your 401k, from your checking account to your IRA, from your main account to your high-yield savings. You never touch it. You never have to make the decision. According to research from the National Bureau of Economic Research, people who automate their savings save an average of 2.5% more of their income compared to people who manually move money each month.
That doesn't sound like much, but over 30 years, that 2.5% difference becomes hundreds of thousands of dollars. Let me show you what happens when you actually implement this 80-20 strategy versus trying to optimize everything. Let's say you make $60,000 per year. Scenario A, the everything optimizer. You spend 8 hours per month budgeting, tracking expenses, clipping coupons, shopping sales, and comparing prices. You save an extra $150 per month through all this effort. Your savings rate is 12%. After 30 years, assuming 7% returns, you'll have about $728,000. Scenario B, the 80-20 strategist. You spend 2 hours per month, once a year actually, reviewing your big five: savings rate, housing, debt, retirement contributions, and investment allocation. You automate everything else. Through focusing on high-impact changes, you increase your savings rate to 20%. After 30 years, assuming 7% returns, you'll have $1.2 million. Same starting income, 1/4 the time spent on financial management, and you end up with $472,000 more. That's the power of focusing on what actually matters. Now, you might be thinking, Tyler, but doesn't the small stuff add up? Aren't you telling me to ignore leaks in my budget? And look, I'm not saying the small stuff doesn't matter at all. What I'm saying is that if you haven't handled the big five first, optimizing the small stuff is like rearranging deck chairs on the Titanic. Get your savings rate right, get your housing cost under control, eliminate high-interest debt, max out tax-advantaged accounts, set up a simple, automated investment strategy, and leave it alone. Do those 5 things, and I promise you, you will build more wealth than 80% of people while spending less time and mental energy on your finances than basically anyone you know. That's the real secret. Wealth isn't built by obsessing over every dollar. It's built by making a handful of smart decisions and then letting compound interest do what it does best. So go audit your big five. Figure out where you're leaking money on high-impact items. Fix those. Automate everything. And then go live your life knowing that your financial future is handled. If this video helped you realize you've been focusing on the wrong things, make sure to hit that subscribe button and drop a comment telling me which of the big 5 you're going to tackle first. I read every single comment, and I genuinely want to know what resonates with you. All right, I'll see you in the next one.